Hello, this is Tom Kestler with Kestler Financial Group. Our presentation today is on marketing in the perfect storm. You know, we've got a lot of challenges facing all advisors today, but as we started looking at some of those challenges, we realized they're all converging at about the same time. And I started using the analogy of marketing in the perfect storm because, as in the movie, if you've seen The Perfect Storm, there's a convergence of a lot of different risks that we're facing today. We've got baby boomers, we've got the bond bubble, inflation, longevity, and the 4% rule, and we're going to really look at each one of those. But if you remember the movie itself, in the very beginning, there was a weather forecaster who was looking at his monitor and seeing what appeared to be this storm coming up the coast, a hurricane coming up the coast, a cold front coming in from Canada. And he's excited about this whole prospect of what could be a perfect storm. And explaining this to his assistant, who, as you can see here, is extremely interested in what's going on. And so the first question I would ask is, in your practice, are you the weather forecaster or are you the assistant? Or to put it another way, are you the weather forecaster projecting what's going to happen in the future, helping your clients with what is coming down the road? Or are you maybe the news reporter that's telling your clients what have happened or what has happened in the past? And I would propose that we all need to be the forecasters rather than the reporters. But in the event that you're looking in the past and not paying attention to what's coming down the road, then the question is, are you sailing your practice directly into this perfect storm? So let's take a look at some of these issues, some of the risks that we're facing. The first one, again, not necessarily a risk, but something we have to deal with as advisors, is the baby boomers. If you go back to 1946, World War II had just ended. Millions of servicemen and women returned from the war, and obviously had one thing on their mind, because from 1946 through 1964, 76 million babies were born. And as these baby boomers, as we call them, worked their way through our society, everything that they touched was changed. When they were newborns, there wasn't enough formula, there wasn't enough bottles, there weren't enough nurses to go around. As they got older, there weren't enough strollers, there wasn't enough schools, grade schools, then middle schools, then high schools, then colleges. So there have been these unprecedented demographic shifts through the years. And if you look at the baby boomers as a percentage of our population, through the decades, everywhere they went, they were dominant. In the 50s, the 60s, 70s, 80s, 90s, 2000, and today the baby boomers are the vast majority of our population. And my question to you is, as an advisor, is I've been in the business almost 35 years. But I was classically trained in the accumulation model. Most financial advisors are genetically wired to try and make money grow for clients. And the idea that our clients are moving from an accumulation model to a distribution model is somewhat strange to us. Many of us are still planning for our clients based on the accumulation model, although most of them are moving into distribution. And the rules change. The techniques are different, the processes are different, the products are different when you move to a distribution model away from an accumulation model. So there's this classic paradigm shift that our clients are going through as they move from accumulation to distribution. Their objective changes are switching from I want to have enough money to retire to I don't want to run out of money. Their allocation process in that accumulation phase is always a portfolio allocation. Where do I put my eggs? How do I allocate my eggs in my basket? And as they move into the income phase, it becomes more of a withdrawal allocation. How do I take income out of this bucket? Their time horizon moves from a known time horizon, I want to retire at 65 or I want to retire at 70, to an unknown lifespan. We don't know how long people are going to live, so we're planning for an unknown consequence, which makes our job geometrically more challenging. So the question is, are you still living in your practice in the accumulation phase while many of your clients are living in the income phase? And um, that challenge then is that anytime we have that classic battle back and forth is when you run into compliance issues and planning issues and unhappy clients. Let's take a look at the bond bubble. If you go back to October 9th, 2007, the market hit an all-time high, at least at that point, and then began a 5-year plunge and was the second worst market decline in history from 2008 to 2012. And during that 5-year period, almost $2 trillion moved out of equities, out of the market, into bond mutual funds. That's just bond mutual funds, not the bonds themselves, not ETFs, bond mutual funds. And to put that in perspective, let's take a look at how big 2 trillion really is. So if you compared dollars to seconds, and you went back historically 1 million seconds, how far back would you have to go? 12 days. So 1 million seconds is equal to 12 days. If you go back 1 billion seconds, that's 31 years ago. 1982, Ronald Reagan is still president of the United States. If you go back 2 trillion seconds, that's over 63,000 years. You're in the middle of the Ice Age. So the point is 2 trillion is a huge number, and that's just bond mutual funds. Those of you that are familiar with bond pricing know that if you buy an individual bond, even though the price will vary over time, you know at the end of the period of the bond, 10 years, 20 years, whatever it is, you will get your principal back, assuming the company doesn't go bankrupt. But so you can control your yield somewhat. But if you're in a bond mutual fund, you have no control over the bond itself. You can't hold the bond to maturity. You lose money and you continue to lose money very easily. And that's where a lot of these dollars have gone, is into the bond mutual funds. So almost $2 trillion. So for those of you that may not be familiar with bond pricing, there's an inverse relationship between interest rates and bond prices. As interest rates drop, bond prices will increase. And vice versa. As bond prices or as interest rates rise, bond prices will drop. Now, to give you an example of that, let's say you bought a $100,000 bond today, 10-year bond, paying 3%. What you're really buying is the income that the bond generates. So you're putting in $100,000 in exchange for a $3,000 annual income, knowing that at the end of 10 years, you'll get your $100,000 back. Fairly simple. But let's assume that interest rates increase to 5% a year from now. Somebody could buy that same $100,000 bond or a newly issued $100,000 bond at the new interest rate of 5% for 10 years, and they could generate $5,000 of income for exactly the same investment that you're only getting $3,000 of income on. So what the net effect is that if you wanted to sell your bond at that point in time, you'd have to sell it at a discount because they could go into the open market and buy a bond that's paying them $5,000. So this chart comes in handy to help you see the effect. If interest rates increase, and they are obviously increasing today, but let's just assume that interest rates increase just 2%, and you've got that 10% or 10-year bond that you're holding on to, that discount that you would have to sell that bond for would be 15%. In other words, a $100,000 investment just lost $15,000. One point to keep in mind, bonds today are selling or are yielding 400 basis points or 4% lower than their historical average. If you follow that red circle down to the 4% row, that's a 28% loss in value. So if bonds just go up to where they have historically been, Your clients who bought bonds in today's world are going to lose almost 30%. Pretty significant risk that we haven't really had to face historically in the last 30, 40 years. So we call that the bond bubble. Interest rates are low, but the clients and the reps are saying, I've done so well with this. Why are you telling me that there's risk in this bond? And we as advisors have been telling them for the last 30 years that the bonds are safe. So we are at risk because we've been giving advice to our clients that you should invest in these safe bonds to move away from the market, or use bonds to mitigate some risk in a stock portfolio. But the client typically makes investment decisions based on what I call a rearview mirror approach. In other words, they'll look historically and say, look at how well my bond fund has done. And yes, it has done well because rates have been dropping. What they forget about is that we've already bounced a little bit on the bottom and rates are starting to move up. Their bonds are going to be losing value. And the advisors, what I would call the lazy advisors, are going to the prospectus and saying, look how well this XYZ bond fund has performed by this bond fund. And they're making recommendations based on past performance as opposed to what could happen in the future. And that goes back to the comparison I did earlier between the weather forecaster, what's coming down the road, that's how we should be working, as opposed to the news reporter who's telling them what happened in the past. So that bond bubble can and will burst, and it creates an issue. So let's take a look at interest rates. This is the 10-year Treasury over the last 30 years or so. And as you can see, rates have come down, and based on that teeter-totter we saw earlier, as interest rates drop, the value of the bond will grow, which is why when you look in the rearview mirror, those bond funds or bonds themselves look pretty good. But what most people forget is the bump. We've bumped off the bottom. Interest rates are starting to rise again. And in a rising interest rate scenario, all of those bonds, whether it's a bond fund or the bond themselves, have significantly higher risk than they have had for the last 30 years. A lot of people have never seen bonds losing value in our industry. This is something really to be aware of. This is where the weather forecaster comes in. So what you need to consider is take a look at your clients who either own bonds or bond mutual funds or bond ETFs. Are they aware of the risk? Again, doesn't mean they're bad, but they need to be informed that there is risk coming in those types of accounts. Variable annuities, bond subaccounts or the fixed subaccounts and variable annuities could be at risk, especially those bond fund allocations where if you add an income rider, that there's a mandatory bond allocation that protects the company. It doesn't necessarily protect the consumer. So they force you into that. Another one of the concerns should be the TDFs or target date funds. I read somewhere that about 40% of the dollars going into mutual funds today are going into target date funds, which if you're not familiar with how they operate, as you move closer and closer to that target date, which is typically your retirement date, your allocations within your 401k move more and more heavily into bonds. So what happens is you're actually sailing into that perfect storm, fat, dumb, and happy, because you're not controlling it. The fund itself is doing that for you. And that's often the default allocation in most of these accounts. If you don't pick one, that's where it goes. So we've got the bond bubble looking at us, coming down the road to us pretty quickly. Inflation is another issue. If you look at our historical rate of inflation over the last 40 years, most of us, or most people who have been in the business less than 30 years, have dealt with relatively minor inflation. But if you go back to the 70s, we have very large budget deficits. Does that sound familiar? Very high taxes. And when my wife and I bought our very first house back in the 70s, our interest rate on our mortgage was 15%. and we thought we were getting a good deal at that point. Um, Very few people have gone through that process or have that pain associated with it. They don't remember what high inflationary periods and high interest rates can do to your investments or to a portfolio. So um, in 1980, Ronald Reagan and Paul Volcker, who was headed up the Fed at that point, um, uh, they pushed to lower taxes. They started decreasing the money supply, and once that happened, you saw we somewhat stabilized inflation, but the 40-year average, even after that, is at about a 4.46% inflation rate. Now, keep that number in mind because we're going to come back to that a little bit later on. Although recently, most people will use 3. 4.46 is the average, and I would propose to you that that's probably going to be low going forward. And the reason I say that is money supply. Most financial people will tell you that the one thing that drives inflation is money supply. How many dollar bills is the government printing and putting into circulation? And over the last 4 years, we have added significantly to our money supply. $2.64 trillion, that's about an 83% increase just in the last 4 years. Now, we haven't seen an 83% increase in inflation, and the only reason for that is that the Fed's monetary policy, this QE, quantitative easing, where they're purchasing back their own bonds, has kept interest rates low and really kept inflation rates low. But at some point, they're going to have to remove, like the Dutch boy, remove their finger from the dike. And when that happens, we're going to start seeing this pent-up inflation that is building up behind the dike. So I would propose that you need to be planning for significantly higher inflation going forward than we have seen in the past. Longevity, another one of these risks that we have to worry about. This is life expectancy at birth. And if you look back, say, 1,000 years, life expectancy was about 25 years, and that made sense. We didn't have antibiotics, there were wars, there was pestilence, there were saber-toothed tigers, all of those things that tended to reduce life expectancy from birth forward. You move forward to the 1900s, then penicillin is discovered, and we can kill off a lot of the germs that are killing us off. Saber-toothed tigers are gone, but life expectancy increases fairly rapidly. 76.5 maybe is life expectancy at birth, maybe around 2000. But keep in mind, that's the at-birth life expectancy. If somebody makes it all the way to retirement, maybe we should be paying more attention to what is life expectancy at retirement. If you've already made it to that point, you've already dodged all the buses, all of the wars, a lot of the sicknesses and things that kill off people early that tend to drive that life expectancy at birth number down. But if you've already made it to 65 or you made it to 70, what is your life expectancy? And this graph shows us that for a 65-year-old, there is a 60% chance for a husband and wife that one of them will live at least to age 90. There's a 31% chance that one of them will live to 95. So my point is we need to be planning for our clients for a 30, 40-year life expectancy, unlike what it would have been, say, 20 or 30 years ago, where you plan for 10 or 15 years into retirement. So much longer period of unemployment, if you will, for those clients who are retiring today. Time in retirement, as you can see, 1900, 1.2 years. Now we're spending 20, 30 years, maybe 40 years in retirement. Interesting factoid, Social Security was passed in 1935 when time spent in retirement was in the single digits. I wonder why we're upside down in Social Security today. 4% rule, finally. If we go back to 1994, William Bengen is the person that's been given credit of coming up with that 4% rule. And basically what he said was that if you have a portfolio that's comprised of 50% stocks and 50% bonds, that would allow a client to take withdrawals increasing or beginning at a 4% withdrawal rate adjusted for inflation for a 30-year period, and they would have a 90% chance of success. Now, I want to introduce a factor to you, something to really think about today is probability and magnitude. So the probability of failure here is 10%. But the magnitude of that failure, somebody that's, say, in their 80s or 90s running out of money, that's a very large magnitude. So give you a comparison, if you were getting on an airplane to fly from New York to Los Angeles and they got on the PA system and said, we have a 90% probability that we're going to make it to Los Angeles without crashing, would you get on the plane? Relatively low probability, relatively high magnitude. But if they said there's a peanut shortage and we think we're going to have enough peanuts to serve back to about row 20, but if you're sitting in row 20 to 30, there's a 10% chance you may not get your peanuts. You'd probably still get on the plane. So same probability, totally different magnitude. So that 4% rule, though, has been kind of the backbone of the retirement industry for about the last 30 years. Recently, we've started seeing some chinks in that armor. 2008, William Sharpe published a study that the 4% rule may not be what we thought it was going to be. And then Dr. Michael Fink and Wade Pfau with the American College and David Blanchett with Morningstar poked more holes into it, and their basic premise was that although it worked in the last century, it may not work going forward because it's based on 20th century rules, 20th century data, 20th century results, 20th century bond pricing. And they said based on today's market, today's economy, that 4% rule would have a 57% failure rate, that it's going to 57% chance that it's going to crash and burn. One point that I was unfamiliar with was when Bengen built his 4% rule, he did it based on a pure portfolio of stocks and bonds. There was no adjustment made in his calculations for any type of fee. So if you're a financial advisor and you're putting a 1% fee on a portfolio that you're managing, just the effect of adding a 1% fee to that 4% rule took it down to about a 2.8% calculation. So the point is that the classic rules of thumb, 4% withdrawal rate, aren't necessarily the right way to plan a client's retirement, and if you do, you're planning to fail. So think about clients of yours that may be in retirement and may be using that 4% rule. How comfortable are you, or will they be, with those withdrawals if we get a market correction or the bond bubble blows up and their bond position loses 30%? So keep those things in mind. So my point is that we need to have a wake-up call. And as I mentioned earlier, the tools, the techniques that you used for accumulation are going to be totally different than the tools and the techniques you use for distribution. I equate it to taking a look at this picture. Your accumulation model is like paddling across a lake. I mean, you can, for pretty much your entire journey, you can see the other shore. You know you're going to retire at 65, and you know that if you keep your eye on your destination and you just paddle constantly in the direction of your destination, you're going to reach your goal. You're going to hit the other side. But when you move into retirement, it's a different picture. It's like a winding, raging river. I remember taking a raft trip with my younger son several years ago, and a bunch of his buddies and I were on a raft, and we got on the river and we're paddling along, splashing each other, having a good time. And we go around a curve, and the next thing you know, we're in a class 4 rapids. And immediately I knew who the most valuable person on that raft was, and that was the guide sitting in the back, because he knew what was coming. He knew what was around the bend. That's what we need to be for our clients. We need to be those guides because we know what's coming around that bend. So this perfect storm of issues all are converging, just like the movie, and our clients are going to have to deal with those issues. So what my question is what is your practice doing? Are you driving your practice into this perfect storm? Or are you like the weather forecaster who says, hey, there's a storm here, we need to change course, or we may end up crashing and burning our own practice. So what do we do? Recently, there was a white paper published by Dr. Wade Pfau, who is the head of retirement planning at the American College, and Rex Voigtland, who heads up the Nexus Research Institute. Many of our advisors have seen Rex speak at our IRA Inc. or Income Inc. training programs. And what they proposed in this white paper was that there were really 4 major risks to sustainable retirement income. The first one was a sequence of returns risk, a sequence of equity returns. The second one was a sequence of bond return risks. The third was inflation. And the fourth was longevity. And what they said was, if you're building a retirement plan and don't plan on mitigating each one of these 4 risks, your plan may be doomed to failure. So let's take a look at some of these. We already looked at the bond side, but let's look at sequence of returns. This is an illustration of $1 million invested in the S&P 500 back in 1980, just leaving it sit from 1980 through 2010. And then following the sequence of returns, this is the S&P 500. As you can see, the returns, 1980, 25.77, and then a -9, a +14. That's the actual return in the S&P 500, and then the gain or loss in the ending value. If you take the sequence of returns and you turn it totally upside down and apply it in reverse, what you will find is that your performance, total value at the end of that 30-year period, 31-year period, will be identical, $11,440,000. And the point is that when you're in an accumulation mode, sequence of returns, although it's not insignificant, it is much less significant than it is in a withdrawal scenario. We'll see that in a second here. But because sequence is less of an issue in accumulation, you can actually use things like averages. Use an average of 8% or 9% when you're projecting values down the road, because sequence isn't that big of a deal. Obviously, if you get all +20s, that sequence string becomes a big deal. But as you can see here, if you use exactly the same returns and just jumble them all up, you'll end up in exactly the same place. But you take the same scenario and impose a withdrawal scenario on it. In this case, we're using that same $1 million investment in 1980, starting with a $75,000 a year withdrawal and increasing it at 4% each year. Going back to that 4% rule calculation. In that example, this client who retired in 1980, 31 years later, last withdrawal was $243,000. There's still $534,000 in their account balance. There's still change in there. That was a successful retirement scenario. If you, however, take that sequence of returns, turn it upside down again with a withdrawal scenario, what you'll find is that this client didn't survive, or their money didn't survive. Their account crashed and burned in just 12 years. So sequence of returns is extremely important when you kick over from accumulation to distribution. Keep that in mind. The efficient frontier is what most advisors have been using to build their practice over the years. This, again, Harry Markowitz said that he won the Nobel Prize for Economics with this, but he said that any client with any specific risk tolerance, for any client with a specific risk tolerance, there is a combination of stocks and bonds that will give them the maximum return for the minimum amount of risk. And that is the efficient frontier. So what advisors have been doing over the years is working with a client whose portfolio they analyze, and they say, okay, your portfolio today is where that X is. And if you're comfortable with your current risk, and risk is measured from left to right on the horizontal scale as standard deviation. Return is measured on the vertical scale. So if you've got a client that's sitting at the X, I know that if I reallocate their portfolio a little bit, if they know they're comfortable with the amount of risk that they're taking, I can reallocate their portfolio, keep the risk the same, but get them almost 100 basis points or 1% more in return over time. At the same time, I know that if I've got a client who's comfortable with the amount of return that they're getting, I can significantly reduce their risk by reallocating their portfolio in the other direction. And so the advisor has always been doing this type of a calculation. Let me show you how much I can increase your return for no more risk, or lower your risk without giving up any yield. Give me all your money. That's how advisors have been capturing dollars over the last 20 or 30 years. So the planning process has always been a combination of art and science, and what we're doing at Nexus is using science, using actual detailed science to make the art a little bit better. So if you take a look at the efficient frontier, again, a little bit different curve here, but essentially the same concept. We know that there are clients out there, say at A here, with a 20-80 portfolio, 20% stocks, 80% bonds. A little bit more moderate investor might be a 40-60 blend. A little bit higher risk tolerance might go to a 60-40 blend. What we have found is that historically in that accumulation story, by using index annuities as a third asset class, we can actually increase the return, decrease the risk. For example, if we add 20% to a portfolio, in other words, rather than using the traditional apples and oranges, say 80-20 conservative investor, we add a different asset class to it, and we put 20% in an index annuity. So it would be 20% stocks, 20% index annuity, 40%, or I'm sorry, 60% bonds. We can actually shift that efficient frontier to the left, which is reducing risk. If we had 40% of an index annuity, 20% stock, 40% index, 40% bonds, we can shift it even more to the left and not necessarily give up any yield at all. If we put 100% in an index annuity, you remove all the risk, but you lower your yield. We've also found that if you've got a a little bit more aggressive investor, you can put more dollars in the equity side if you put 100% of the bond portfolio into an index annuity. You totally eliminate the bonds, especially knowing that bond bubble that we're facing. So this is the accumulation story. And what does it look like when you're moving into distribution? So the white paper is really the second white paper that Dr. Fowl published in 2013. The first one that he published, breaking free from the safe withdrawal rate paradigm. And what he found was that in his first white paper, that knowing the bond bubble that we're coming up against, what are our choices? Where else can we put those dollars to mitigate the risk? And what he found in that early 2013 white paper was that if you eliminate the bonds and you replace the bond allocation with a single premium immediate annuity, yes, a SPIA, that was the best combination of assets to provide an ongoing retirement income for clients. And Rex Voetlin with the Nexus Research Institute knew Dr. Fowl. He wrote to him, said, have you considered using an index annuity as opposed to a single premium immediate annuity? And he, again, with traditional index industry bias, said, no, these things don't work that well, blah, 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 blah. And Rex said, well, let me feed you the data. If I can give you the numbers of an index annuity, will you plug them into your engine? Since he already had it built, he said, absolutely, no problem. And these are the results. So this is what I would call the efficient frontier for withdrawals. The where you want to be is the upper right-hand corner, the smiley face. And what it's doing is it's saying what's the value of my assets at death? That's the vertical column. In other words, I'm taking withdrawal. How much change do I have left? So you have more change left as you go up vertically. And the horizontal axis is the percentage of lifetime spending needs that I can take care of. So the blue line is the traditional efficient frontier, traditional stocks and bond blends. At the very top, we have 100% stocks. Then we go to 80-20, 60-40, and so forth. At the very bottom, 100% bonds. So where we want to be is upper right-hand corner. And what Dr. Fowl said is, let me take a look at a couple different scenarios. He said, first of all, let me do a blend of stocks and a variable annuity with a guaranteed lifetime withdrawal benefit, an income rider. And eliminated the bond position and applied 20% of a variable annuity in this example here. 20% of a variable annuity, 40% in a variable annuity, and so forth. And as you can see, we start to get a tail on this. The more of the dollars that move into the variable annuity, the more you mitigate against longevity. And because of that, you get that little bit of a tail. And he sees that that's an improvement. He said, well, what would happen if we mixed a single premium immediate annuity in this scenario? How does that look? And that's the red line. So as you can see, you get closer to that upper right-hand corner, which is where you want to be, because the variable or the index, one more time, the SPIA, the immediate annuity, will mitigate against the risk of bond failures. It also mitigates against, to the degree that dollars are in there, mitigates against the risk of sequence of returns. And it also mitigates for that longevity risk. So the more dollars that are allocated into the single premium immediate annuity, the more you move over to the right, so you're taking care of that longevity concern. And this is pretty much where he stopped with his paper, and he said, this is the best combination. It's stocks and a SPIA. And Rex wrote to him, and he got some pushback from the industry, and the industry again has that bias against single premium immediate annuities, the what happens if I get hit by a bus concern. But we do know that SPIAs can provide the maximum amount of income for the minimum amount of dollars, and annuity engines, whether it's SPIAs or VAs or index annuities, are the only financial instrument that can provide an income that you can't outlive. So Rex wrote to Dr. Fowl, said, would you consider plugging in the numbers from an index annuity and see how that works? He did that, and the green line was the result. Now the green line is essentially a Nexus annuity, the BCA, Balanced Choice Annuity, with our income rider. The income rider is one of only two in the country that we're aware of that has a cost of living increase that is based on the CPIU, the Urban Consumer Price Index. So as interest rates or inflation rates increase, payouts will increase to the client. And the green line, as you see, runs fairly parallel to the red line. The big difference is, and the big advantage to the client, is that unlike the red line in a SPIA where the dollars that go in there are basically gone forever, you're trading assets for income, in a index annuity with an income rider, you're doing a withdrawal scenario. So to the degree that you're taking withdrawals, there's always going to be, or at least in the early portion of the scenario, there's going to be significant remaining residual value in the annuity in the event of death, which keeps it performing fairly well. And notice that this is a 3% inflation assumption, which is what Dr. Fowl was using in his scenario. So Rex said, well, what would happen if you took the inflation assumption from 3% to 4%? That's what happened. As inflation increases, because we have the rider with the inflation adjustment built into it, there is a significant improvement to the scenario with a higher inflation. Now keep in mind the slide I showed earlier where the historical inflation over the last 30 years was 4.46%. So the question I would propose right now, this is 4%. What happens if we go to 5 or go to 6? That green line is going to move further and further towards the smiley face in the upper right hand corner. And the point is that in a income scenario, you need the stocks in there to give you the growth potential, but you also need that annuity insurance or spreading of risk to provide a lifetime income that you can't outlive. And to the degree, like I said, with an annuity as part of the portfolio, the dollars that go into the annuity are totally, you totally mitigate against sequence of returns. You totally mitigate against sequence of bond returns because there is no bond allocation in the portfolio at all. You mitigate it against longevity because it provides an income you can't outlive, and you can mitigate for inflation. So the results of the white paper were that maybe the ideal scenario for income at retirement for a sustainable inflation-adjusted retirement income is a combination of stocks and an index annuity with an inflation rider. So that is all in this white paper. If you would like a copy of the white paper, if you haven't already seen it, I urge you to read it. This is what puts all of the science behind everything that you've seen here. All the footnotes, all the detail, all the calculations are in there. Give me a call or send me an email. My contact information is here. Phone number is 800-699-0299. Or my email is tkestler@kestlerfinancial.com. I'd be glad to send you a copy of the white paper. Thank you for your time. I appreciate all of your business and look forward to talking to you soon.